Hello everyone, welcome to the latest Lunar Quarterly Update. Today we'll be looking at UK economic growth, we'll touch on inflation, we'll touch on what's happened to markets, both bonds and equities over the second quarter, and we'll also touch on the impact that the elections are having on markets as well. So I'm going to share my screen now. Firstly, some good news. On the left-hand side here, you can see UK economic growth going back to 2012. You can see the different components, which are the different coloured bars. You can see the purple line, which is the overall real GDP figure. Real GDP figure takes out inflation. And the headlines earlier on in the year was the UK was in recession. And we had two negative quarters of economic growth in the second half of last year. But they were very weak numbers in terms of economic growth was only just negative. But technically, the UK was in recession. In the second quarter, the quarter that's just finished at the end of June, we had some positive news on economic growth within the UK. The economic growth data for the first quarter was that the UK expanded by 0.7% in the first quarter, which is quite a strong figure. So it's good to see that the UK economy is performing stronger. But that's not really a surprise to us. As you can kind of tell, we're talking about the first quarter data being announced in May. Economic growth data is always announced with a bit of a lag because it takes so much time to calculate it. But on the right-hand side here, you can see UK Purchaser Manager Indices. They're surveys that are conducted on a monthly basis, which give you a real good idea about what's going on in the economy right now. And as you can see, those lines have been improving. So if the line is above 50, it means the economy is expanding. So services is in that purple line and manufacturing is in grey. And you can see manufacturing particularly has been recovering from the middle of last year and is now in expansion territory. But you can see that services has been bounced back strongly. It has come off a little bit from its highs, but it's still well above that 50 level in the expansion territory. So the data which is being surveyed right now is pretty positive on the UK economy. So it's encouraging to see as we move into the second half of the year and expect economic growth to be slightly stronger this year. Since the COVID pandemic at the end of 2022, when the economy's reopened, economic growth has been bouncing around zero. So these are the first data which has been stronger from an economic growth perspective. And the Bank of England and the IMF and other central governments, etc., have been upgrading their figures for the UK for 2024. So, a lot better from an economic growth perspective. And one of the reasons for that is because we're all feeling slightly wealthier again. Inflation is back down to the 2% target, but wage inflation is running higher. So the headlines over the last 2 years has been about the cost of living crisis, how things are very difficult, etc. But a lot of that is behind us now. And looking forward, inflation is likely to stay lower over the coming months. So this chart here goes back to inflation back to 2021. It's got different components, so services, goods, food, alcohol, tobacco, etc. The big increase in electricity, gas and fuels in the middle of 22 after Russia invaded Ukraine and commodity prices spiked. And you can see that at the end of 2022, inflation was running at 11%. Fast forward the clock to where we are today. Inflation's been falling significantly over the last year or two. And as I said, we're back down to the Bank of England target of 2%. Now, it is good news that we're back down to the Bank of England target, certainly. And looking forward, it is expected that inflation is going to continue to be low. The only thing I would say is it might be slightly higher from today, because you can see you've got those bars below zero, which are acting as deflationary forces at the moment, which is electricity, gas and liquid fuels. As we move to the end of this year, that impact is going to start to wane because prices will be flat. So they won't be deflation anymore. And on the flip side, service inflation, which is that blue bar in the middle, is proven to be quite sticky because wage inflation is quite high as well. So you could see inflation starting to drift up. I mean, it's not going back to the levels of late 2022. It might get to 2.5%, 3% perhaps. But it's nothing to be concerned about, and it's a lot closer to the Bank of England target than we've seen historically. And why does that matter? It matters because the high inflation in the UK was the reason why interest rates were increased significantly during 2021 and 2022. And you can see, interest rates at 5.25, they've been flat for a period of time now, but significantly higher than we've been through for a long period of time. After the financial crisis, interest rates have pretty much been at zero or 0.5% for nearly 15 years. So we've been used to a world of lower interest rates, and that's impacting borrowing that we take and has made financing cheaper. And we're now refinancing at higher levels, and that's having an impact and will continue to have an impact over the coming months and years. In our view, interest rates will probably be cut in August. Expect the first 0.25 cut, so bringing interest rates down to 5%. If it's not August, it will be later on in the year, but it's not if it's going to happen, it's when it's going to happen. And you've seen other central banks lead the way here. So the European Central Bank has already cut interest rates in Europe. You've seen Canada cut interest rates. Swiss National Bank have cut interest rates as well. So it's really not the Bank of England being an outlier if they do decide to cut interest rates over the coming months. The Federal Reserve in the US, they have been a bit slower to cut interest rates. They haven't made a cut just yet, and that really impacted markets over the second quarter, and we'll touch on that shortly. And that was a function of just stickier inflation within the US. Going forward, we'd expect maybe one interest rate cut a quarter. So you get interest rates down to more like 3 to 3.5 to maybe 4, that kind of range, 3 to 4 for UK interest rates. That's where we see longer term interest rates. So we have one cut this year and maybe 4 cuts next year, you're back down to 4%. So that's based on what we see at the moment. Clearly, if economic growth surprises to the upside or downside, you might see that path of interest rate cuts being accelerated or decelerated at any one time. In terms of markets, these are bond markets. It's been a slightly choppier period. You can see the blue bar, which is gilts, really sold off in April. That was a function of the stickier inflation that we mentioned in the US, and the fact that it was expected that you get 4 interest rate cuts in the US at the beginning of the year, and the Federal Reserve had come out and said, no, we'll probably only just have 1. Bond markets have since recovered. You've seen, as I said, the ECB cut interest rates. The expectation is that the Bank of England will cut interest rates, as I've already mentioned. So bond markets have recovered significantly from there, but it's been quite choppy. You've made better returns from strategic bonds, which is that yellow line there. And you've lost 1% over the quarter in government bonds. Corporate bonds is around 0.5% down. What about equity markets then? I think let's start with the bottom line, which is the Nikkei, which is that yellow line. Japan has performed very strongly over the last year. There's been significant reform within the Japanese stock market. Japanese companies are also quite cheap, and the Japanese market had done very well. So I think the last quarter really reflects a little bit of profit taking, and that's why Japan has been slightly weaker. We still like Japan as a stock market. The reform that's coming through and the valuations still look pretty attractive to us. The purple line on the flip side talk about a market that was completely oversold and unloved, China. I mean, that's the Hang Seng, which is the Hong Kong stock market. China at the top has been up 9% during the quarter, but is very volatile. China has been in a bear market for nearly 3-4 years now. The stock market is lost significant value, and to me, this just looks like it's a bounce from very depressed levels. More on the positive side, the NASDAQ 100, which is that light blue line, has performed very well. Technology shares in the US continue to perform well, driven by that artificial intelligence theme that's been grappling with the markets over the last 2 years. And Nvidia became the largest company in the S&P, overtaking Apple during the period, over 3 trillion in terms of market cap. So certainly a lot of positivity that's been going through within those names, and that really propelled technology. And you can see also the S&P 500, which is a dark blue line, to be up over 4% during the quarter. Closer to home, the kind of maroon line, the FTSE All-Share has performed very strongly. You're seeing a lot of merger and acquisition activity within the UK, some big companies across the market cap spectrum being bid for. You're seeing share buybacks, which is significant. So companies seeing that their share prices are too cheap and trying to do something about it. And and you're seeing also increased dividend payments as well. So there's a lot of positivity within the UK market at the moment. On the flip side, Europe struggled a little bit in the quarter, and it's really come at the end of the period, and that was driven primarily by the French elections. The French elections really rocked the market, and the surprise snap election that, excuse me, that Macron called. So it's been a little bit weaker for Europe during the period, and that's primarily been driven by France. I think it would be amiss of me not to talk about the UK general election and elections in general at the moment. The markets, as in the UK gilt market, sterling, and the UK equity market, haven't seen a lot of volatility around the announcement of the election, which was during a period. And I'm recording this after the result has been known, but we haven't seen much volatility. If anything, it's been slightly positive for UK sterling assets that Labour have got a majority and are taking over the UK politics situation. So UK politics hasn't really caused any volatility. If anything, it was the expected result. So markets sort of expected that it was going to happen anyway. An unexpected result maybe would have caused more volatility, but we haven't had that. And if anything, the strong majority means that you could have a kind of a nice, stable political system in the UK for the next 5 years, which is something that, you know, we should be encouraged and something we were looking for as a result anyway. On the flip side, you're seeing politics deteriorate elsewhere. We've already touched on France. There's issues or ongoing debates in the US, which is causing some volatility. And that's something that we're very mindful of as we move through the course of this year. That being said, we still feel valuations are pretty attractive and feel that this is a good time for long-term investors, whether you're the more cautious end, given the returns available from bonds now that interest rates are higher, or equity markets, despite their strong run over the last year or so, still look pretty good value to us, and we believe it's a good entry point for longer-term investors. Just like to say thank you for your time today. If anyone does have any questions on this or anything to do with your Luna portfolio, please feel free to speak to myself or a member of the team at any time. We're always here to help and answer questions on your portfolio or any other financial matters that you might have. Thank you for your time. Enjoy the summer, and we'll be back in autumn time now to give a bit of an update, and maybe we'll have an autumn statement to digest from the UK as well. Thank you very much. All the best.